Stocks falling after negative GDP data. The U.S. economy contracting for the first time in 3 years. Joining me now, we've got Mike Bailey, FBB Capital Partners, Director of Research. You're looking at companies that can adapt to new tariffs and find creative ways to grow. How can investors locate these opportunities?
Absolutely. So they're certainly everywhere. You just take a look at the S&P 500. You can look at the top of the list, kind of and work your way down. I think for us, as we're thinking of again, navigating some pretty choppy waters here, tariffs, when are they going to happen? How big are they going to be? Is it going to drive a recession? A lot of questions out there. A few things to think about. One is quality. You're buying a quality business. What does that mean? Generally, is it a more profitable company? So that's something that can help you out. If you're a big company, profitability is pretty good. If tariffs kick in and they're pretty challenging, you've got a little bit of wiggle room there. You're not going to maybe get crushed as much as a low quality company that's barely scraping by. So that's something to think about. The other piece is diversification. So if there's a business that's doing 2 or 3 different things, you can talk about maybe Amazon. They've got e-commerce. They're doing cloud computing. They're doing online ads. Things like that, that businesses that've got scale and diversification, they can sort of minimize some of that risk that may hit more concentrated companies.
And so, Mike, with that in mind, as we were breaking down some of the latest economic data, how are you kind of reading through and assessing companies that are best positioned to weather any type of GDP or broader economic contraction?
Yeah, it's a great question. In general, if this is, let's put aside tariffs and say, hey, this is just a regular economic cycle. It goes up and goes down. If the economy is shrinking, typically more defensive type companies do better. So you're looking at consumer staples, maybe utilities, could even be telecoms or pharma, for example. So those companies tend to do, you have to go out and buy these type of products or use them regardless of the economy. So that tends to be the part of the economy that's done better. Those sectors have done okay this year to date. I think investors are worried about a recession. So that's generally kind of the starting point. However, I think the caution is that if you sort of put everything in your portfolio into that safe part of the market, as the economy turns and improves, you're going to miss out on the everything else kind of recovering faster, cyclicals, tech, and growth, et cetera. So certainly important to be diversified in that portfolio, but keeping an eye on some of those safer defensive names, definitely keeping some of those in the portfolio this year will be helpful.
Right, and as investors are once again hearing even more of the R word getting tossed around here on the day in recession, important reminder that the technical is typically 2 quarters of consecutive contraction here on the GDP front. And then even after that, we still got to wait for the NBER to come out and say, okay, yeah, it's happened, and we'll validate this. And they look across a range of factors. All those things considered here, Mike, I wonder, what is your top thesis right now prevailing in the markets, especially given some of what's expected to be continued chop?
Yeah, absolutely. So just looking at where markets are now and kind of what's next, I think we're kind of viewing things as frankly a tug of war. So markets are down about 10% from recent highs. That's sort of almost a no man's land. If there's a recession, stocks are going to be down probably 20% plus. If tariffs go away, there's no recession, we probably flip right back up and go back to where we were back in kind of February. So it's a little bit, there's definitely some tension here. As we're thinking through what's next, we do see tariffs having a significant impact already. We're seeing slowdowns in international shipping, seeing some kind of tea leaves suggesting that things are slowing down. So I do think there is a risk of a bigger economic slowdown. And yeah, I think investors, again, you do want to make sure you've got that diversified portfolio. Make sure you've got some safety or defensive type stocks to own. Maybe you own a little bit more now. Again, wouldn't go too much overboard there, but that's kind of where we're looking. Again, pretty tricky here. Again, the policy is changing hour by hour, but I do think some of the stuff that's happened is leading towards slightly higher odds of recession. You want to make sure your portfolio at least has some protection in case that does happen.
Just lastly here, Mike, how should investors be thinking through their portfolio as to whether or not the companies that they've invested in or sectors that they have exposure to will actually see exemptions come their way? And I guess within that, is relief enough of an investment strategy, especially knowing how much of some of the contraction that we've seen in the market pullback is self-induced?
Yeah, absolutely. So yeah, I think it's certainly the big question. Which companies will really feel the heat if tariffs kick in a big way? So at this point, we've seen a few things around the edges. We've seen airlines kind of see some pressure. We've seen shipping and transportation see some pressure. Other than that, it's really been kind of hit or miss. We really haven't seen a clear indicator of which companies really are going to see a lot of downside. So we're going to have to sort of wait and see. And that's certainly not a great answer, but I think that does get back to diversification. And I think you're going to see a lot of surprises. One example could be in healthcare and pharmaceuticals. Certainly there are some tariffs threatened that could be coming against drug companies. However, big global multinationals are out there saying, even if tariffs kick in, some of these big companies with scale have the ability to start moving around their supply chains and make local and sell local, so that can minimize some of the tariff risk. So really a lot of moving parts. I think given the unknowns, it's really important just to stay diversified, make sure you've got some of these quality companies that kind of are doing different things, and that's probably the best way to go.
All right, within that wait and see, some more volatility is expected here. Fortunately, I've got my floaties. Mike, thanks so much for taking the time.
Thank you.